Hello, reader. This video is just this is a two-part video. I don't think I can do it all in one go, but this is a two-part video where we're going to look at the ideas I put in my 2024 list and what became of them. Where are they today? Obviously, we've got the I'm recording this on the 30th of December, so this this is there's still one more or half a day, half a day to go. But you never know. It all might kick off tomorrow morning. So just to recap, I mean, gosh, it feels a long time ago that I wrote this, but back on December 25th, 2023, so it's just over a year ago, and I'm going to be covering these in this first video. We'll start with Diversified. We'll just do them in order, and I mean, just quickly work through. The sort of original thesis, I guess. So back then, so this was sub £11. It was on a very high yield. Yeah, I mean, obviously, from my point of view, the numbers looked extremely strong, which is why I liked it. Um, there was some challenges. The challenge around methane emissions, challenges around ARO, people claiming that yeah, they're going to be forced to decommission their producing gas wells, which wouldn't make much sense, but uh, some different things. And anyway, I did a couple of things to arrive to those conclusions, that comparing them to close competitors, other peers in the market like EQT and others, that there was also this myth of that DEC was running out of resources. There was also the complicated hedging and IFRS 9, and to be fair, I think a lot of people just simply didn't understand that, which kind of made profits look very strange. So, I suppose with the various tipping services, you will get, and you do get, and have got headlines that say, "Oh, DC have lost a vast load of money, but they've generated hundreds of millions of cash flow." It, it, it's there's more to it, and it intrigued me as to how it could be so cash positive and so unprofitable on the face of it. And it was, just getting my head round the inner workings of this particular accounting rule, which I sort of intuitively knew, but yeah, just kind of digging into to understand that. We're going to talk about Digital 9. So this was the one that had dropped the investment trust that had dropped the most in 2023. I kind of saw it as, yes, it had again challenges, but the sale of Verne was imminent. I liked the assets. Um, this one delisted, so I'm not really going to cover this because there's nothing much to cover. I mean, the value is still there. I'm for 2025, I'm not kind of making further comment on it. I still hold it, and we'll see. I mean, I think waste fuel has a great future. It's got some other interesting holdings, so we'll see. Baker Steel, we'll talk about today. Agronomics, we'll talk about today. Um, Bell, Tech, and TMT and Kazera. So lots of ground to cover. So let's start with DC. So this is my article from just a few days ago, from yesterday even, a few days ago. Time passes in a strange way. So yeah, look, I guess where do we start with this? I mean, it's up on the year. In fact, it probably, because it's shot up this afternoon. Let's have a look. It is sitting at year to date. Let's just do a little refresh on my list. So yeah, it's 21.5% up year to date. It was 15 year to date this morning. Kind of gives you an idea. Um, so yeah, it's done very well, but it's had a very tumultuous year. So that's the 1 year performance. So we can see ha having backed it at 10.76, £10.76, which is probably about here. It dropped in January, dropped further in February, shot back up. Then here in August, dropped back to the same lows. So it's been an interesting year, but yeah, look, I mean, when it dropped here, I sort of thought to myself, well, look, the gas price is what it is. It's not going to stay as it is. So I leaned into it and have done very well out of doing so. I mean, it's now at 1332. Tomorrow, I expect it will go up further. Um, this natural gas, you can see, is up 17.6 today. So it's so it's it may even go to $4 whilst we're recording this. Who knows? But this is up dramatically, and there's been a large withdrawal of gas reserves, as I predicted that would happen. Um, that yes, inventories are still high, but they're dropping fast. Production is dropping, and these are all points that I make in this article, that this is the gas production 2024. So we can see it's dropped by about 4 billion cubic feet per day. Will this just be a temporary thing because businesses have shut in production, or does it point to something wider? And these guys, uh, for example, talk about the geological model and how this rolling over of the Permian is predicted and predictable. They've predicted other things with great levels of accuracy, so we'll see. Everything has a finite level of resource. So you can sort of see the flattening out. If that's not a bell curve, I don't know what is. And we can see bell curves, on some of the other fields, and so for example here, the Midland field, that the bell curve is just part of what King Hubbard, the very famous Shell geologist, predicted, with quite some level of accuracy. So exports, meanwhile, are going up, and this drill baby drill rhetoric is export baby export, just equally. So I can see how Trump will be encouraging gas exports. And by doing so, that will obviously feed into raise demand for US gas, and therefore raise prices. So I do see that there'll be a flattening out. But the other thing to say is that electricity production is increasing. That at least some of that is going to come from gas. So as a share, it's dropping. You can see the share is dropping to 40, but because in absolute terms, the amount of electricity is increasing, there's still a big role for gas to play, and the need for extra capacity of gas power production. We can also see that there's higher prices forecast ahead, and 2024 has been pretty horrendous for prices. So you can see, there was times when it dropped down to below $2 per. And just to give you an idea, I mean, you multiply that out by 6, that's kind of equivalent to a barrel of oil. So we're talking, $10 a barrel of oil equivalent for US gas. I mean, that is just incredibly cheap when you consider that, the black stuff is, and I don't mean Marmite, the black stuff is 7.5 times that price. That if we consider UK gas prices, which are here, £1.20 a therm. Um, that's kind of a therm is one tenth of a. Let me think about this. It's one tenth of a MC. No, one tenth of a barrel of oil, I believe, um, and therefore, in dollar terms, I mean, we're talking that's the equivalent of $150 oil price equivalent. It's gas is a lot more expensive in Europe, substantially more expensive. So and this price here, the per megawatt, this pretty much always follows the UK price. There's no great differential between them. So even though this looks lower, it's roughly the same as this here. So anyway, uh, I see DEC as being, it's going to have a strong 2025. It pays a good dividend. It's paying down debt. It's increasing its decommissioning of wells. But people sort of message and say, "Oh well, when's it going to start decommissioning thousands and thousands of wells?" Well, it will do so when it stops producing from those wells. You don't decommission producing wells. That just makes no sense. I mean, if you want to, you know, run a sensible business, then you keep as long as there's no safety issue, you keep producing until it's not economic to keep producing, surely. Uh, but of course, there are state agreements as well. Each state, US state, mandates a certain number of retirements or plugging, as they call it. So look, the key point for me is that there's the capability. That next level is increasing. They've increased their number of rigs from 17 to 19. That will probably scale up into the 20s next year. They're doing third-party wells as well as DEC wells. So yeah, I mean, they will grow that decommissioning as they need to, as makes sense. There's no point keeping a well going if it's not economical to keep it going. They're being monitored on methane emissions. So if you can't just sort of, ignore the problem, you've got an army of aficionados that seem to want nothing else than for DEC to fail and go sort of checking up on the wells and inspecting the wells, trying to make television programs about them. They've only managed to make one program, and it was about 4 years ago, and it was a well that DEC had acquired through an acquisition. So it wasn't, you know, like it now had the DEC name on it, but it hadn't been DEC's well until very very recent. It was sort of almost like just after the acquisition of it. So I mean, it felt a little bit unfair, shall we say, that um, you know you acquire assets and then, well, I mean, I suppose, yeah, legally you are on the hook for them, but yeah, it seems to me that everything that I've read about and understand about DC is that they are quite um, reasonable and responsible. I don't get the impression that they're a bunch of cowboys. That are looking to pull a fast one. There's no evidence to that. In fact, the attempts that have been made to present that as evidence have been roundly refuted. So yeah, look, people will still try. People will talk about the the asset retirement overhang till they're blue in the face, because it, for whatever reason, for reasons best known unto themselves, they are passionate about doing that. Only for DC, not generally. I mean, it's interesting because I actually engaged with some of these people and, like, well, what about more broadly? Have you contacted EQT? Have you contacted other companies? Oh, no, just DEC need to do this. Okay, what? So, what about offshore oil? Oil that's thousands of meters under the ground, and if we have another Deepwater Horizon type situation with oil leaking into the sea, that's devastating for the environment as well. Oh, no, we don't care about that. We just care about DEC. So I kind of find the whole thing bizarre and weird that people are fixated on the asset retirement obligation of DEC and none other. Um, I think DEC have their house reasonably in order. So that's my opinion. And I've not really seen any evidence to the contrary. And I've read lots of attempts of such evidence, and yeah. Anyway, look, um, I'm conscious that I've got a lot of ideas to get through here, so I could talk about TEC for probably longer than the 15 minutes. I did say I was going to be very brief. So yeah, look, I'm really positive. I mean, I think this chart sums it up. So this is the past performance. This one here is where I've annualized the numbers. So I've taken, in fact, I've taken 9 months of data for 2024, which is what we know about, up to September, and then just multiplied it with all these numbers out by 1.33 to get a sort of a 2024 number. I mean, if anything, I'm undercooking what the actual numbers will look like. I very much suspect, but you can see, for something where, well, up until today you could buy it for 640 million. I suspect that market cap has moved by about 30, yeah, there we go, 30 million today. So yeah, for 678 million, to be able to bring home 150 in a really terrible year, and let's say 2021, which was that was when gas prices were much higher. That they were able to bring home about 260, 270,000, sorry, 270 million in net income. I mean, that's pretty impressive. That's pretty impressive. I sort of say here, that works out at 23p of earnings in a bad year and 40p in a good year. So yeah, I do think there's upside. I do think there's upside to that. I mean, some of that cash, of course, is going to have to pay down debt. That it is highly levered, but it's highly levered in a way that it's ABS structure, so amortize. Oh, the acronym stands for, but anyway, the amortizing the amortizing debt structures that are largely fixed rate debt that do come with some obligations, but it also means that it's it's predictable. So in some weird ways, that whilst this has been a tumultuous year with tumultuous events, the share itself and the company itself is in some ways quite boring and predictable, because you know pe- gas is required, they produce gas, they're looking to do it as cheaply as possible, they're you know they're hedging so that, if gas prices shoot up, they're not going to see all of the upside of that, but if gas prices plummet, they're not going to see all the downside of that. So it's all quite, steady as she goes in many ways. But yeah, there are some upsides, things like the coal methane and other ways, that this assumption that all of these gas wells are going to have to be plugged and are never going to be used ever again, and have no other purpose in life other than a potential environmental disaster is kind of missing the point. There's lots of other possibilities, and having spent millions and millions digging holes into the ground, I mean, if nothing else, there's a potential, things like hydrothermal and storage of various gases, hydrogen as an example, or carbon dioxide as another, that having been the source of CO2 emissions, in the sense that the gas gets burnt and as it gets used and creates an environmental problem. Ironically, they might end up being the solution to those environmental problems if we as a species can work out how to sequester carbon dioxide economically. At the moment, it's not terribly energy efficient it's possible to do, but it takes a lot of energy to do it. But what if we find a different way of doing it? I mean, human ingenuity, perhaps we'll see some breakthrough technology where all of a sudden CO2 can be captured very economically. Perhaps it'll be graphite nanotubes. Who knows? I mean, I'm just making things up, but you get my point that these liabilities may one day be assets in themselves. So anyway, that's all for tomorrow. This I think will do well over 2025. Moving to DGI9. This is my latest article, and this, one of the reasons that Digital 9 has suffered this year has been around uncertainty. So there's been uncertainty around a lot of things. One of which was the cable. The cable that's running from India to the Med, which is one of their holdings, one of their projects, project called EMIC1. And this is kind of a little bit tongue in cheek, a little bit, trying to be sort of a little bit light-hearted about what is actually quite not a great situation, that the world has kind of been held hostage to the pinch point of the bottom of the Red Sea. And I suppose the fear was that they wouldn't be able to lay the cable that would connect, but they have. It went without mention. It's a bit disappointing that the management team at DGI9 don't feel it appropriate to inform the market of its progress. But hey, I guess that's that anyway, it's in the public domain that the cable has made landfall. They're going to run it across land through Egypt, and then they're going to exit it into the Mediterranean and then connect it from the Mediterranean into I think it goes to Algeria, Sicily, or sorry, Italy, and one other place, maybe southern France. So essentially there'll be a Europe to India connection, with then spurs off for I think it's Oman and a few other countries along the way. So I mean, I personally think I mean, obviously the share price has been horrendous, the performance has been horrendous. So my so I mean, looking at my year to date, it's minus 39.2. It has been a horrendous year for this asset, but the assets themselves are actually incredibly, as far as I'm concerned, the assets themselves are actually a lot stronger than the share price would suggest. That you've got Arqiva that I mean, Arqiva's going nowhere, gone nowhere. That we're all still watching TV, we're all still listening to the radio. They make all of that happen, but they do a lot more than that. They're actually they've got satellite services into over 100 countries. They've got uh, um, water meter contracts that are growing. A water metering business that's growing, very successful. One of the leaders in its space, and the and Ofwat are looking to expand that to I think it's 10 million additional homes, because the point is that if you've got a dripping tap, the water meter will tell you about it. Like it. If you've got a dripping tap, you'll have a little sort of 24 hours a day draw on the water, so it goes right. Okay, you've got a dripping tap. I mean, very often it's a toilet. This toilet system doesn't shut properly, and you get sort of like water flow into your toilet 24 hours a day. But at the end of the day, if you're on a water meter, that's costing you money. Um, so so yeah, look, I mean, Arqiva alone is worth um, more than what you can buy DGI 9 for. And with DGI 9, you're effectively owning 51.75 of the economic interest of Arqiva. So even that alone kind of covers the share. And then there's other holdings as well where these are holdings that are in markets and industries with very high demand, data, AI. Like, apart from the terrible the terrible write-up that this share has had, and the various misfortunes it suffered. I mean, the whole thing with Vern and the volcanoes in Iceland, the whole thing about the string of advisors, the triple point that have now been given the heave ho. Uh, there's a lot of things that were very, very wrong with this idea. But I guess what I fixated on, rightly or wrongly, because I suppose I can learn some lessons from this, was that the assets are good. It's um, and I guess particularly I looked at Arqiva, and I looked at the history of Arqiva and how it sold its telecoms business for 2 billion. Um, the wider thing was valued at 6 billion. So I mean, 51.75% of 6 billion. And by the way, it did sell the telecoms business, and that was offloaded, and then DGI 9 bought the rest of Arqiva. But since that was sold, and uh, um, they started the water metering business, so that's gone from zero to something approaching um, what the telecoms business was pushing out 7 8 years ago. So could Archivas float as an IPO, or as a trade sale? And if it did, at what price? I struggle to see how DJI 9 would lose money, and in fact not make money. There's obviously other shareholders, there's other complexities. It's a very, very heavily indebted, very, very highly levered business. So there's a lot of debt. So there are challenges. I mean, it's something that they would have to work through, and they acknowledge that in the latest update. One of the challenges as well is that we don't actually know the makeup of the NAV. So we've been told it's in our best interests to not know that information, which is what I say here, that they won't tell investors. The subtotal is 403 million. Um, uh, so quite what that's made up of is open for question. Is it that they've written off Arqiva? Is it that they've written off? So let's have a look. So this is something that you can buy for 156 million, where the NAV is 400 million, and the underlying assets. I mean, as I say, half of Arqiva, where it potentially is worth into the billions. 400 million is kind of very what's the word? if anything, the 403 million, which was written down from 700 million, by the way, um, to me felt like, you know, a kitchen sink in and fire sale, and this works out at about 47p. So would be a an upside to a year ago when I suggested this idea. So yeah, I guess, you know, it will come out in the woodwork in 2025. I still hold it. I still believe that a positive outcome will transpire. I think I really liked the fact that there's an upside for the new investment manager if they can achieve above, I think above 300 million, that they will see some extra performance fees, so which I'm more than happy about. You know but I don't think I don't think they would have taken it on if they weren't pretty confident that they can get those. It doesn't make sense because the base fee is actually less than what the old people were, the Triple Point were charging. So why would you do it for less unless you felt that you could get that performance fee? So just my my thinking. What I've tried to do here is try to set out, you know, where do I think the values lie. And what I've done is I've introduced some elements that aren't in the balance sheet because they're held not at Topco, they're held at Holdco. So and there's also things that have been written off that, you know, may or may not actually be recognized later on. I mean, looking at Vern and the sale, they sold it where 107 million was kind of future, like a future earning, and they've written off nearly half of that future earning. But from what I can see and from what I know of the growth of data centers and of AI, and that Ardian, the new owners, you know, have poured a vast sum of money in to support Vern, so they are looking to invest into it and grow it and make a return, make a profit. I find it hard to believe that we're only going to see half of the earning. Again, I think that whoever's done this has sort of covered their behind, uh, trying to be sort of prudent, as you have to be in accountancy, but that's not to say that that's likely or realistic. In my opinion, I would be surprised if the outcome is that, you know, half of it is lost because Vern is a bit of a disaster. Just that certainly the words coming out of their mouths don't reflect that reality. And when I say there, I mean Ardian and the news flow coming out of Vern itself. Okay, so and also the growth that it was, the growth trajectory it was on before it went to Ardian. So it was, I think the last results, the 2023 results were 70, 80, 90% growth. You know, it was seriously impressive levels of growth. The problem was with that growth was that it's cash hungry. So the fact that Ardian have got very deep pockets, and I think it's 1.2 billion that they've invested into it. Great, you know, if you put the investment in, you'll get the return. Simple as that. So anyway, that I do feel quite positive about. So the outcome of this idea, watch this space, I guess. Moving on to Baker Street. Sorry, Baker Street. Sorry, Baker Steel. It's Mr. Baker and Mr. Steele. So I don't know who Mr. Street is, but clearly he doesn't work here. Anyway, so this is a bit of a conglomerate of different holdings. Um, I kind of looked at it a year ago, over a year ago actually, and kind of looked at the holdings and thought, wow, you know, these are just completely mispriced. And during 2024, they've made some really great progress. Looking at CMOS, there I think is their largest holding at the moment, percentage wise. Comparing it against another Moroccan cement maker, um, it's vastly undervalued compared to its NAV. Now this one has returned 43% this year, so this is the highest, second highest idea. Well, unless something happens tomorrow morning, who knows? But yeah, 43%. I mean, I'm surprised it's not more. In fact, in 2025, I'm pretty certain it will be more. These guys are going to turn cash generative and probably start paying dividends. The Moroccan, the World Cup is going to be partly in Morocco, so they are they're building lots of stadia and different things. The Generally, Morocco is doing very, very well. It's an offshore centre for the EU. They they're also developing oil and gas and supplying that into Europe. So there's quite a lot going on in Morocco. It's fifth largest African economy, and this kind of gives you an idea of so yeah, I think when you look at, for example, Lafarge Holcim Maroc, if I'm pronouncing that correctly, um, comparatively, um, the 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 comparison is um, that CMOS is dramatically undervalued. Maybe as much as three times, um, but potentially much more, six times. Part of part of the challenge here as well is that Basrat is on a discount itself. So it's on a 30% discount even after going up 43%. Now, part of that will be that its NAV has grown through the year. It hasn't grown by, you can see it here. It hasn't grown a vast amount. It hasn't grown a vast amount. It's and actually, it sort of got close to 60p and it's dropped back a little bit. So it sort of closed to about 25% and dropped back. But yeah, there's quite a lot of upside to. Let me just close some of these down. So let's close him. And that's just one holding. So moving on to there's then 5 listed holdings, and what I've been doing throughout the year is just keeping an eye on what does the listed price look like, and we do get a bit of a catch up, with the NAV will sort of catch up, but it's normally 1 to 2 months behind. So Silver X at the moment, I'd say has dropped back a bit, but I'd say Silver X should do well in 2025. This has got a lot of, as the name suggests, silver mining, but also gold and some other base metals as well. So I could see this being higher still in 2025. These guys, they're going to be getting their so it's Caledonia. They're going to be getting their Bilboes DFS in Q1 2025. So I think again we're going to see some really good upside from these guys in 2025. This one is a Australian and German tin miners, quite early stage, but really strong economics, like incredibly strong economics, to I think something like a 53% IRR to the project. This one is Tungsten West down in Devon, and tungsten is a bit of a popular uh, 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 um, discussion point of metals at the moment, because China controls 90-ish% of world of refining, of tungsten refining, and about 80% of actual tungsten mining. So have a real pinch point. It's used in weaponry, military, um, different applications. It's a very tough, strong, high melting point. So this is in the throes of financing, but that could have some real upside in 2025. And then finally, these guys have done a deal with Condor. So the Condor mine in Nicaragua is, again, incredibly strong economics. They're chucking off loads and loads of cash in the Philippines. Their mine, Runruno, is going to run out in about 2 years. So they've bought Condor. They're going to develop Condor, and I could see this one doing incredibly well. I've actually bought Condor rather than MTL. On the news, I couldn't believe that I could get it at. I think I paid 28p, and the price that they've bought Condor for is kind of equivalent to 44p. So yeah, incredibly good, incredibly good. But it's one of these that just doesn't seem to get a lot of recognition. It's very, very overlooked. So I mean, when you add all of these up together, the the NAV, well, the cash, and then these listed holdings kind of come to 21.7. So the whole thing is 57. Okay, so you're talking like over a third of the list of over a third of the uh, you know Baker Steel is actually backed by listed holdings and cash, and then you've got the cement maker that, I mean, possibly could IPO in 2025. It might not be as quickly as that. It might be late, might be 2026, 2027, but could IPO. That's another form of upside. And actually, there's been some news. It's not in this article, but there's been some news with Blue Moon and taking the copper mine. So there's just move down. Um, Somewhere in all of this will be. As you can see, there's lots and lots of moving parts to this, but there is a copper mine in Norway that has been bought. There's also Prognos, which is the third largest undeveloped silver mine that's no longer undeveloped. It's in production, and the company that owes, or the company that has the net smelter royalty liability, is based in Kazakhstan. So even though this is based in Russia, it's what used to be Polymetal that's now called Solid Core, and these guys are making, you can see it here, net profits of over $200 million. Are unfortunately legally on the hook for the NSR coming out of Russia, which and I've kind of said here, the royalty is worth about 2.5 million a year for 20 years. So I mean, that's the market cap of Baker Steel in its own in its own right. Just quickly as well, there is a royalty over a net smelter royalty over the Bilboes mine. So next quarter, when it's listed holding, Caledonia presumably push ahead with the development of Bilboes. That you know that that's going to be one step closer to that starting to generating cash for Baker Steel as well. Finally, I don't want to miss this one out, just to mention Futura, because again, this is a large part of the NAV. So this is metallurgical coal. They've got two mines, both are in production. One started producing in June of this year, so 6 months ago, and there was a little bit of slippage because of rain and weather. Uh, they're based right next to a coal handling and preparation plant, a CHPP, and so they've not really had to build a lot of capex. They've just had to get some diggers and start digging, and then truck it over to the neighbouring processing plant, and then send it off to customers. So the margins on this, I mean, operating costs of 85 a ton. The current prices on met coal are vastly higher. I mean, they've dropped. I think they're still at about 190 today. They were higher than that, but um, considering that they own a quarter of Futura, they also have a royalty over the production as well. And yeah, I mean, this 34% of NAV, this is potentially going to just be a money machine, because met coal is needed for steel making. It's needed for yeah, and China, India, Indonesia, are all developing their steel making capabilities. Other countries as well, South Korea, Japan. So there's a need for this met coal. It obviously is CO2, uh, but I mean, at the moment there is no alternative other than some limited green steel. eh, and that requires high purity. High purity iron ore, which there's a handful of iron ore mines that meet that criteria, and for the rest, the purity is so low that the cost of using an electric arc furnace would just be horrendously expensive. So yeah, at the moment there is not an alternative, unless we, as a society, say, well, look, we'll do without steel. We'll not build things. We'll just make do. Um, you know, without sort of new steel, which just ain't going to happen, is it? So, anyway, that's that. I mean, there's more that I could say, but I'm going to sort of leave it there for Baker Steel. But as you can tell, I think it's going to do really well in 2025. Moving on to agronomics. So this is an interesting one because I mean these have got some really interesting holdings across different parts of cellular agriculture and precision fermentation. Um, I'd say the ones that I'm going to particularly call out are Liberation Labs, which is now a few months away from starting production. I read that they have got letters of intent that cover 200% of their capacity. Um, if that's true, then they're going to be, busy from day one. And if they're busy from day one, the um, the numbers that the CEO has talked about, these are EBITDA numbers, is about 20 million, 20 million EBITDA per year. Agronomics own 37.5% of Liberation Labs, and it might be a little bit higher now because there was a follow-on of 2 million. But yeah, 37.5% of that suggests 8 million EBITDA accruing to Agronomics. I mean, I'm not saying that's 8 million that's going to flow to the coffers, but it's 8 million EBITDA. I mean, on the basis that the capex has been around 110, and let's say it's a 20-year life, you're looking at 5 million of um, depreciation and amortization. So that 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 sort of takes the numbers down to say 14 and a half. Tax, I mean, take 20% off that, so you're left with about 11 and a half, and possibly some debt in there. Most of it is equity, but let's say there's some debt in there. takes it to maybe 9, something like that. So 37.5% of 9 million, $9 million annual net profit kind of still gets you to a business that has proven itself. If it's oversubscribed, if it's 200% oversubscribed demand, then the next thing that they're planning to do is to move from 400,000 litres to 4 million, maybe not all in one go, but to basically to replicate what they've done and to build larger facilities that would be even more economic. Larger scale would be less costly to operate per litre. So that alone kind of covers um, about half of the. So if we look at the numbers on this, so let's go to Agronomics. So 39 million quid, and the holding with. Let's have a look. The holding with. Let me just grab it from over here. The holding with Liberation Labs alone is, I think, 25 or 30. So let's just grab that. Which is here. So, and this is sort of my last. Yeah, that date's not accurate. I think that's sort of as of 3009. I think is when I last updated it. So, yeah, Liberation Labs is this one here. So it's 25.6. So 60% of the share price is backed by Liberation Labs, and if it's chucking off, what do we say? About 3 million a year. And if you say, well, 10 times PE or 12 times PE, that kind of gets you to above 25. That gets you to above 25. And yeah, I think there's some room for optimism really around this. And then there's some other holdings as well that I mean, these guys are now listed. The Formo had, in fact, my article talks about this, that there's been various fundraisers. I think 300 million of $300 million, I think, of fundraisers in 2024. And these fundraisers have been at full value. So when you consider that ANIC is about 70% discount to NAV, so the market cap's 40 million, and the NAV it has moved a little bit, but it's something like 170. I mean, you can see the just the vast, 75% discount to NAV. Now, I think that will be lower now. There was, I think, an update, and I need to write an article about this. The leather holding, I think, has been written down. Vitro Labs, I think it is. So Vitro Labs has been written down to zero. So there's 8 million written off from Agronomics. I think what I would say to people sort of a bit dubious, should we say, about Agronomics and the whole area of lab grown meat, is to say, well, first of all, it's not all about meat. There's other products, so chocolate, palm oil, just different different things other than meat. So the kind of, I don't want to eat weird lab grown meat, kind of, well, it's not just about meat. That's the first thing to say. Second thing to say is, well, I think the way agriculture and meat production works now isn't great. You know, the antibiotics, the stress hormones, the risk of contamination, you know, all of those things are problematic today. So it's not as though um, meat production is perfect, and what this represents is something horrific. I mean, yes, it does need to be safe, and that's why um, there's a generally there's a process that they have to go through to demonstrate safety. No two ways about it. It's also the case that it's likely to start by pet foods and pets is sort of the probably the thin end of the wedge a little bit. Um, but also the underlying technology is basically brewing. So, you know, if you've ever drunk something called beer, um, or you know, eaten something called yogurt, I mean, these are all fermented. Uh, these are all fermented products as well, and that really the technology isn't much different to that. The bit that's different is that they're taking stem cells, um, to kind of start the process off, and then feeding them sugars and amino acids and heat to kind of cause the cells to multiply and duplicate, that to essentially grow the solution from which they can form fat and meat, uh, muscle and fat and different cells that then make up meat essentially. So I guess that's the other thing to say. But the other way to look at this is to say, well, forget about it being anything about meat. Just think of it like a product, and is there a demand for that product? So treat it like vaporware. Is there a demand? Yes. Um, from the market research I've read and seen, there's a lot of people that will eat this. Um, and you've only got to go. I mean, what I would encourage you to do is go and visit a vegan food fair, and go and look at the prices, and go and look at the number of people milling around and buying cheese and different products at those prices that they are, and you'll realize that there is a market for these sorts of products, even if they're not, um, the same price as a value, whatever chicken pieces from your local supermarket. I mean, will it be able to kind of compete with conventional meat? Probably not in the beginning, and that's why I kind of really like ideas like the bluefin tuna, because at the end of the day, it's far easier to compete with um, a meat that, or a fish that costs, that's critically endangered. So there's the morality of it, but that costs hundreds of pounds per kilogram. So if you're producing something that's costing, I mean, approximately, let's say 50, 60, 70 pounds a kilogram, well, you've got the market cornered because you're producing it far less, far more cheaply than uh, um, certain fishermen catching these critically endangered fish. So and you can still sleep at night as well, to boot. Anyway, so yeah, I personally, I really like agronomics. I mean, has it disappointed? Yes. Should it have done better? Yes, I think it has been a very unfortunate performance, but I think it's being unfairly punished, and the value there, as far as I'm concerned, the value is obvious, and I think we'll see a much stronger performance in 2025. I remain convinced of that. So anyway, I'm going to move on. As I say, I could talk about this for a lot longer. Moving on to Belluscura. So again, Belluscura has been a minus 60% performance. So another terrible performance. Uh, what can I say about Belluscura? I mean, struggled to make ends meet. They did a reverse takeover that was meant to take weeks. It took months, and that wasn't necessarily Belluscura's fault. They were told one thing, and it transpired to be another. Um, I do think this idea could do well in 2025. I mean, it's bombed out to an incredibly cheap price. I mean, you can buy the whole thing for 15 million. Um, it's got an agreement with Foxconn, which is the makers of the iPhone over in China. They've got an agreement with Foxconn that's worth multiple times that over the next 5 years, starting from 2025. They've um, they've got a market leading product. Nobody else can do what they do. They tick a lot of boxes around Medicare codes, and so it's all about being able to claim certain levels of Medicare, as I understand it. But they qualify for two different codes, which is really important. So it it needs to sell. I mean, that's basically been the challenge here, is that they've been cash strapped, but the news flow, albeit recent, 22nd of November. Uh, the news flow is positive, that they've now got commercial finance, so it's a 3-year facility, that will provide $4 million, and that they're going to launch full production early 2025. The soft launch was earlier this year. So they're being backed by a large bank. So that all looks positive. Um, but I mean, they've got to get on and sell. They've got to launch this Discover product. They've got another product, Explore, that's already in market. Um, Looking at the competitors to Explore, I mean, there are a few out there that are now starting to catch up. So maybe there'll be some price pressure in 2025 on Explore, but nothing that touches Discover, for its um, size, its power, the amount of oxygen it can deliver, its price point. It's the market leader, no two ways about it. But yeah, I still hold this. It is sitting on a loss. That's kind of you'd have to be doing extremely well to be on a profit with Belluscura, because of its share price performance this year. But sort of see it there. Um, but I think 2025 could be a better year for it. I, I I I don't think it's out of the woods, but it was certainly encouraging to see sales increasing since the summer. So they are appearing to be ramping up. So we'll see. I would say, if you asked me to choose between this and um, other ideas, I'd probably pick the other ideas, to be fair. But it's not to say this won't and can't do well in 2025. So Bell is part of Tek. Tek holds Bell. Tek also holds other things. So moving on to Tek, Tek floated its Gen IP. Gen IP's doing okay, actually. So it floated at, I think, 30p. GNIP is its ticker, and yeah, it floated at 30p, and it's 25 bid, 30p ask. And you can see here, it's actually gone above its float price, so it's kind of holding up reasonably well. Tek own about a third of this. So if I just get my little Tek uh, here we go. Right. So, I mean, basically, 1.5 pence of uh, uh, um, Tech's NAV, 1.46 pence to be precise, is backed by a listed company called GNIP. Um, GNIP, I mean, these guys do an advisory service using AI and using human beings to generate a 50 or 60 page report into the whys and wherefores, the practicality, and this is what one of their reports looks like. So, executive summary, what the technology, the IP, the market, SWOT analysis, other products, the likely market size, all of these things. And rather than some poor human being sat there typing all this out, which would probably take them a good a good few hours if they were the oak bloke, and a good few more than hours if they're not. But that sorry, I'm being facetious, but 60-page report, for $1,000 is pretty good value. I mean, if it stops you from committing hundreds of thousands or millions into a fail, an idea that, if it was obvious that it was going to fail because of X, Y, and Z, this hopefully surfaces that X, Y, and Z, so you don't make it. And equally, if you want to get funding and you want to get backing, this is a way that you can, spend $1,000 to kind of get the basis for your business case, because everybody needs to put a business case to get backing. It's rare that somebody will say, well, look, just here's the money, go and develop a business. Who cares what it is? Who cares how you're going to do it? Just go and do it. No, it doesn't work that way. You've got to put a business case that then gets reviewed. So this is kind of a business case cornerstone. So I think, I mean, certainly when you look at the likes of Forbes and the likes of some of the people that are giving it a positive, Duke University is a very high profile US university. Forbes, as you know, is uh, not really. Oh, Inc. is that some sort of magazine? So yeah, they've got some really really strong names, and I kind of like the idea that you could almost build up a bit of an ecosystem around this. And they've got a second business, which is then the placement service as well, which um, is 15,000 per placement, I believe, is the revenue stream there. So yeah, I mean, they're talking about becoming profitable in 2025. Tech own about a third of them. They've got a lock-in on this, but that lock-in is 12 months. Bell, Tech have been selling down Bell, so they still hold about 1.2 million worth of Bell. Actually, that price there, sorry, let me just, that's today's price there. So zero point 0.9 million of Bell. And then Lucy is the next one. So Lucy again has slightly been in the wars. Um, it's trading at $5 today. So I'm just looking at, because obviously the Nasdaq is still open as I'm speaking. So let's just get that. So Lucy is so that's sort of half a p per share. Lucy is a smart glasses business. They launched various different things this year. This is my last article where I talked about the performance, and the problem here has been the acceleration of sales hasn't been as fast as perhaps it needed. So they have had to dilute, they have had to raise more capital, but they've been able to do it easily enough. It's America, I guess. Um, and there's no shortage of people that will take a position, albeit taking obviously a pound of flesh and a discount, etc. So they started at owning about, I think it was 40% of it. Uh, I think the latest is that they own 22% of it now, maybe slightly less. But yeah, they've got agreements with Reebok, with Eddie Bauer, with Nautica. They've launched these Armour smart glasses, which are industrial. So rather than sort of fashion glasses, these are glasses that you can wear in a workplace, factory or a warehouse or something like that. So um, they punch against the likes of Amazon and some really big competitor names. I've got a pair myself. I love them. The talk time or the listen time, because I use them for podcasts, is excellent. I'd say 12 hours is about right. And in the real world, which is good. I personally haven't really found the need for things like the social audio, the Verb app, and stuff like that. But then I'm not a millennial, so I guess it's not aimed at me. Um, but yeah, I think I think I'd certainly miss my lucid glasses if didn't have them. I do like I do like sort of being able to um, listen to things, and I've like, because it's not covering your ears. Like at the moment, I've got this covering my ears. If you're walking down the street and there's a car coming, or something, like you can still hear what's going on around you, because it's sort of the speakers are sort of going through the skull of your head into your ears. So anyway, that's another of the holdings. There's two more to go. The Guidant, now this is going to be floated in 2025, so this is going to be IPO'd. Guidant is a humans in the loop technology for robotics, for autonomous vehicles. They've got customers, they've got pipeline. They're working with various other autonomous vehicle manufacturers. Um, this could be massive. It could be nothing. It's one of these that the idea feels like a good one, and the need feels like it will certainly be there, because if you've got autonomous vehicles whizzing around, well, how do you control them if they go wrong? I mean, you've got to have humans in the loop. Uh, you'd think, because how else do you control them? You can't just allow an autonomous vehicle to just be able to do what it likes. Uh, so some states in America have mandated it. Florida is as one of those places. Um, it's likely that other states will follow, what Florida are doing, but maybe not all. I think Germany is looking to do the same around uh, um, uh, mandating humans in the loop. It makes sense. I mean, I just cannot see how else. You can allow, or governments will allow, autonomous vehicles without some form of control. That all it takes is the robot goes to Lally and smashes in and kills someone and blah blah blah, and it's front page news. And then the lawmakers are like, well, yeah, yes, we're going to introduce new regulations. It Even if they don't, they will, because they'll have to, because it's just an inevitability as far as I'm concerned. So yeah, look, I really like Guidant. I think it could be incredibly successful. It could be the biggest success story of tech. I think it will need to float with some capital behind it. So obviously we need to wait to see the detail of that. But yeah, I feel quite positive. The final holding is Microsalt. So Microsalt was floated at 45p. It's today 74p, so it's nearly doubled since IPO. The holding is worth 12.5 pence. So all of this taken together, and there's another business in here called Revive, which is regenerative shock absorbers for cars, for to basically uh, return battery energy, so about 5 to 10 miles of battery energy back to a battery electric vehicle. Um, that even excluding that one at zero, I mean, all of these, which apart from that 7.4p there, so everything else is listed. So you've got 14.9 pence of listed holdings. And Tek is completely disconnected in price. It's sitting at about 8p bid ask, 89p. So it's completely disconnected from the prices. It's on a gain year to date, but not a very large one, I don't think. 22.6 gain year to date. But you know, it's trading at half its listed value. Microsalt, it can start selling down in April if it so chooses. Microsalt could have some very large customers in the offing. It is taking some time for those deals to finalize. But I think um, there's one that's a multinational food co that I believe is well, you can sort of see there. You can probably tell who I mean by that. Yeah, I think um, if that news breaks, then it will, the whole thing will just shoot up. So potentially just a matter of time. I mean, is there risk? Yes. Could it come to nothing? Possibly yes. Nothing's certain about this, and Tek is pretty cash strapped, so it's not in a strong position, which is a pity. But you can't help feel that if they had, 5 or 10 million sat behind them, that life would be very different. In fact, one of the lessons I've learned from this year is to say, well, one thing to look at the holdings and look at the strength of the holdings, but you've got to look at the kind of war chest that they've got available, and that's been the problem for Tek, is that I think with a larger war chest, that it would have been a very, very different year for them. One of my 2025 picks, Mercia, I mean, they've got a cash pile of 40 something million, and they've got a cash generative second business. Very different to be able to oh, this company needs some growth capital. There's your growth capital. It's very, very different. When you've not got that and you've got to scrimp round and different things, that for me has been I guess a lesson to learn from that. But yeah, that doesn't take away from the value of the holdings, which I think will, in fact, they could all do very well in 2025. And even if, I just say, for example, Lucid just doesn't, it doesn't kind of get that sales growth that I'm talking about. The holding value is half a pence. So we're still talking 14.4 pence. Even if we say, well, Lucid's a write-off, it's zero, worth zero. The fact that these two particularly are at or above their IPO price, their initial price, is very encouraging. Anyway, going to really quickly talk about these because we're sort of we're well above an hour, and you've probably switched off by now. Maybe one or two have sort of said, no, no, I'm going to see it through. But yeah, let's talk about TMT just quickly. The TMT is a venture capital fund. They have, despite, I mean, they're pretty cash rich, they're debt free. They've got a very large holding called Bolt.eu, which is a uh, kind of like Uber type business. So food delivery, taxis, but also some differences. They've got scooters and sort of personal transportation, bikes, Boris bike type things. Um, I I think they've also got a whole load of other holdings that are typically quite small size, small scale. Bolt is the big one. Blaze is another large holding. Particularly like other holdings like PandaDoc. PandaDoc is easily worth more than it currently is. I mean, when you look at Bolt and the value of Bolt, it was written down because Uber and Lyft were written down in 22. So when Lyft and Uber were written back up, or went back up, um, the holding here was just kept the same, because obviously with accounting rules you have to make provision when things go badly, but you don't sort of necessarily you're not necessarily able to just reverse it back out when things go better. So arguably it's held at a big discount to what it's really worth. They're talking about IPOing in potentially in 2025. So that's this has been reported in I think it was Zag Daily, whoever they are, that's what they're planning to do. And um, the IPO of Bulk could be massive if they raise something along the lines of in relation to Uber. If we compare the trajectory that they've moved from um, 1.35 to 1.7 revenue, 150 to 200 million customers. They've made some really big progress. They've moved into 100 new cities. So lots and lots of good progress. Um, the implied valuation of its holding is at 8.8 billion, and that's based on um, the funding round. But really, when you sort of pro rata it against what Uber is worth, um, it could be worth vastly more, vastly more. But even if it's not worth vastly more, um, let's just sort of even just consider that it's only worth what its NAV is. Even if it's just worth that, I mean, you can buy it today at 318 and the NAV is 622, I believe, or 626. So it's about 50% discount to NAV. So the market cap's 93 and the NAV is about 210 million. So again, huge disconnection of value. Year to date performance is 5%. It was a lot higher, I think, during the year, and it dropped back a bit. So yeah, you can see that's the 1 year performance. So back here it was at sort of $4. Now today it's $3, so it's dropped by about a quarter from earlier highs earlier on in the year, and that's not on any kind of bad news. If anything, it gave a very solid update on performance, considering that obviously high interest rates and other things have been detrimental to some of the holdings. It also was impacted a little bit by the Russia-Ukraine war, in the sense that there's a number of holdings based in Ukraine, so have some of which have been marked down to zero. So considering the challenges that it's faced, it's actually done a lot better than the underlying other parts of the business have done a lot better to compensate for the parts that have fallen by the wayside, I guess you could say. Right, I'll move on to the final one, and this is the number one performer of the portfolio. As of today, it is stood at 170% return, so it's almost a triple bagger. And it wouldn't surprise me if it triple bags again next year in 2025. So Kazera is a heavy mineral sands. It's based in South Africa on the border with Namibia. It, um, you know, at a guess, I mean, I've kind of come up with some numbers here where I believe it can push out, a sort of over 3 million net profit from its mineral from its heavy mineral sands operation, and this is just the small scale. The original beach, the larger scale beach, which is this Perd Levely, is 34 times larger. So essentially, it would be potentially 34 times that. So so that was my prior maths. I think I did some more and different assessments and just work through the concentration level of the HMS, work through the prices of up to date prices of different components and this is based upon the MRE that they published, and just kind of got to not quite the same number but a similar-ish number, and that was based on sort of just 12 hours per day, not 24 hours per day, and so on. So you'll notice that some of that's down to diamonds. Now there's so much variability in these judgments. So um, if we're talking diamonds like um, industrial generic diamonds, then they will not be worth very much. If we're talking gemstones, we could be looking at a vast upside to the numbers. So I've just sort of moved it into a just sort of moved it slightly downwards. But even so, even on this slightly downwards again, that 34 times that still applies. So for a share that, even though it's triple bagged, you're still only looking at a 16.6 million market cap, which, if it's chucking off two and a bit million net profit and has the potential to grow that to 34 times that, well, um, even on a 2.5 million, I mean, we're looking at a kind of 6.5 times PE. And actually, the other aspect here is that they are owed money, so they've got about 8 million owed on the books from a large Chinese company that is or has agreed to buy Aftan. They also have a royalty over Aftan as well. So yeah, it's interesting, and that's the metrics of Aftan that yeah, Hebe is the company involved. This piece here is the Aftan holding. The bit around it is a neighbouring mine where Hebe are also involved. Yeah, and I sort of say here, look, well, if they double up the equipment and do two trommels instead of one, you could pretty easily get to double profits. If the diamonds are worth more than industrial diamonds, that they are gemstones, after the 40% share, we're still looking at a 10. So look, the upside, when I say it could triple again in 2025, I mean, that's why is that if it tripled from 16 million, it would be at 50 million market cap, and if it's pushing out a net profit of 10 million, well, that's a PE of 5 times, or less than 5 times, about 4.5 times. So doesn't feel like that is that much of a challenge. I mean, this is only a second trommel, which might be a, I don't know, 2 million, maybe not even that, $2 million capex. Uh, and this is just luck of the draw of, what sort of diamonds they're gonna be finding. And and we should see that news in the next month or so. I mean, we shouldn't have to wait a vast amount of time to start to kind of go, oh yeah, actually we have got some diamonds that are um, worth, this much or this much. So we don't, I there's no way of knowing other than little clues like a comment that was made about marine diamonds are generally larger and more valuable than inland diamonds. Whether they're gemstones or not, I mean, the jury's out. But yeah, look, I do really like this idea. I've included some ideas here, also included some comparable heavy mineral sand operations, and what sort of profits they're chucking off. So, it kind of validates, with my model that I've built, that returns 2.5 million, 5 million, 10 million. Those are sort of cross references that where they're generating much more than that, to be fair. And the grades that they're mining are far, far lower. You can see them here. We're talking sort of 5.8%, 4.7%, 3.9%, 9.4%. Kazera's pretty much at about 50%, maybe more. Um, there has been some variability to the percentages quoted, but some quotes were 80% and some are sort of 50%. I mean, from the photographs and the it looks like it's pretty much all heavy mineral sands. Not not that I'm a heavy mineral sands expert, but it um, yeah, essentially, because you're dealing with 10 times the concentrate, um, the economics must be just vastly superior to any of these competitors. Other than obviously they'll be operating on a larger scale, so we'll have some economies of scale, that kind of thing. But anyway, that concludes this video. We're at an hour and a half, so if anyone has watched this through to the end, well done. And I'll record part two. I hope this review of the ideas is useful to you. Please like, comment below, all of that stuff. Subscribe. I mean, none of this is investment advice. It's just me talking about ideas. Just talking my own book, really. It's um, yeah. I'm basically doing this to look to raise money for Emmaus, which is a charity that helps the ex-homeless. If you've contributed, thank you. If you haven't, please do. Um, my Substack is at oakbloke.substack.com. All the articles that I've been showing and talking about today are there. So that's kind of essentially where I publish my content. And thank you very much for watching this video, and cheerio for now.